Welcome to the 10 Minutes Gold Mine, where every book gives you a treasure of knowledge in just 10 minutes. The Intelligent Investor by Benjamin Graham. Book Summary. Introduction. The Intelligent Investor by Benjamin Graham is one of the most influential and widely regarded books in the world of investing. First published in 1949, it has since become a timeless classic, offering practical advice that remains relevant in today's financial landscape. Graham, often referred to as the father of value investing, provides a comprehensive approach to understanding the stock market, investment strategies, and the mindset required to succeed in the world of investing. The book introduces the core principle of value investing, which is buying securities at a price lower than their intrinsic value, ensuring a margin of safety for investors. In this summary, we'll break down the core principles of Graham's philosophy and discuss the key ideas presented in the book, providing a practical understanding of how you can apply these ideas to your own investment strategy. Part 1. The concept of value investing. The first major theme of The Intelligent Investor is the concept of value investing. Graham explains that the stock market often behaves irrationally, causing fluctuations in stock prices that can sometimes be far from the true value of a company. Instead of trying to predict these unpredictable market movements, Graham encourages investors to focus on the long-term fundamentals of the companies they invest in. Value investing is about buying stocks at a price lower than their intrinsic value, which can be determined by analyzing a company's earnings, dividends, and financial position. This approach requires patience and careful research, but it minimizes risk by focusing on companies that are undervalued by the market. Graham advises investors to do their due diligence and avoid speculation, which can be risky and unpredictable. Rather than trying to time the market or chase the next hot stock, value investors seek businesses that are being sold at a discount compared to their true worth. Graham also introduces the concept of the defensive investor and the enterprising investor. The defensive investor is someone who prefers to take a more passive approach to investing, focusing on safety and long-term growth, while the enterprising investor is someone who is willing to take on more risk in search of higher returns. Both strategies can be successful if executed correctly, but they require different mindsets and approaches to investing. Part 2. The margin of safety. One of the key principles introduced in The Intelligent Investor is the concept of the margin of safety. The margin of safety is the difference between the intrinsic value of a security and its market price. In simple terms, it's the buffer that protects you from the risk of buying an asset that may be overvalued. A large margin of safety means you're buying a stock at a significant discount to its true value, which reduces the risk of loss if the market moves against you. Graham emphasizes that the margin of safety is critical because the future is inherently uncertain. Even the most careful analysis may be incorrect, and the market can be volatile. By buying stocks with a significant margin of safety, you give yourself a cushion that protects you from unexpected market events or mistakes in your analysis. This principle is not limited to stocks. It can also be applied to bonds and other investments. Whether you're investing in corporate bonds, government bonds, or real estate, the margin of safety ensures that you're not overpaying for an asset, providing a level of protection in case things don't go as planned. Part 3. The role of market fluctuations. Graham's advice about market fluctuations is one of the most important takeaways from The Intelligent Investor. He explains that the stock market is often driven by emotions, such as fear and greed, which can cause irrational swings in stock prices. He calls this behavior Mr. Market, an irrational business partner who offers to buy or sell stocks at wildly fluctuating prices, often based on short-term emotions rather than long-term value. Graham advises investors not to let market fluctuations sway their decision-making. Instead of reacting to the ups and downs of the market, he suggests that investors should focus on the fundamentals of the business they're investing in. By doing so, they can avoid the temptation to buy during market bubbles or sell during market crashes. Rather than trying to predict short-term market movements, Graham encourages investors to focus on the long-term value of their investments and stay disciplined in their approach. Part 4. The Defensive Investor's Strategy. For the defensive investor, Graham recommends a more passive, low-risk investment strategy. This involves investing in a diversified portfolio of high-quality, large-cap stocks and bonds. The goal for the defensive investor is to achieve steady, reliable returns over the long term without taking on too much risk. Graham emphasizes the importance of diversification in this strategy. By spreading investments across different asset classes and industries, the defensive investor can reduce the impact of any single investment on the overall portfolio. He also recommends allocating a portion of the portfolio to bonds, which tend to be less volatile than stocks and provide more stability during market downturns. Another key recommendation for the defensive investor is to avoid trying to pick individual stocks or engage in active trading. Graham argues that most investors are better off investing in index funds or exchange-traded funds (ETFs) that track the performance of the broader market. These funds provide broad exposure to the stock market while minimizing risk, and they don't require the investor to constantly monitor the market or pick individual stocks. Part 5. The Enterprising Investor's Strategy. While the defensive investor follows a more passive investment approach, the enterprising investor is someone who is willing to put in more time and effort to actively research and select investments. Graham encourages the enterprising investor to seek out undervalued stocks, bonds, or other securities that are trading below their intrinsic value. This approach requires more analysis, but it offers the potential for higher returns. To succeed as an enterprising investor, Graham emphasizes the importance of thorough research and due diligence. He recommends focusing on companies with strong financials, consistent earnings, and a solid track record. The enterprising investor should also be willing to take a long-term view, as it may take time for the market to recognize the true value of an undervalued asset. Graham also advises that the enterprising investor avoid risky speculative investments and instead focus on high-quality companies that are temporarily undervalued. This requires patience and discipline, as the market may not immediately reflect the true value of the asset. Part 6. The Importance of Emotional Discipline. Emotional discipline is another key theme in The Intelligent Investor. Graham warns that emotions like fear, greed, and panic can cloud judgment and lead to poor investment decisions. Successful investing, according to Graham, is about staying calm and rational, even during times of market volatility. Investors must avoid the temptation to chase hot stocks or panic during market downturns. Instead, they should stick to their investment strategy and focus on the long-term fundamentals of their portfolio. By maintaining emotional discipline, investors can avoid making impulsive decisions that can result in significant losses. Part 7. Common Investor Mistakes. Throughout the book, Graham highlights common mistakes that many investors make, such as overconfidence, speculation, and failing to properly assess the risks of an investment. He warns against chasing after high-performing stocks without considering their intrinsic value and urges investors to avoid following the crowd. He also stresses the importance of avoiding performance chasing, which is when investors buy stocks that have recently done well without understanding why the stock is performing well. Instead of focusing on short-term trends, Graham recommends taking a long-term approach and focusing on the fundamental value of the business. Conclusion. The Intelligent Investor offers timeless wisdom that can help investors navigate the complexities of the stock market. Whether you are a defensive investor or an enterprising investor, Graham's principles of value investing, margin of safety, and emotional discipline provide a solid foundation for building a successful investment strategy. By sticking to these principles, you can reduce risk, avoid common mistakes, and focus on the long-term potential of your investments. Whether you're new to investing or an experienced investor, this book provides practical advice that can be applied to any market environment. Have you ever tried applying the principles of value investing in your own life? What do you think about Graham's approach to investing? Let me know in the comments below if there are any other books you'd like me to review next. That's it for today's 10 Minutes Gold Mine. If you found value in this, don't forget to like, subscribe, and keep mining for more golden knowledge. See you in the next one.